Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research. Now, let's get into the numbers.
All right. Today we are diving deep into 3 Acre Farms, ticker TAFL, and we're specifically tearing apart their Q3 2025 results.
And our mission today, it's really about getting to the truth behind the numbers. We want to uncover what we're calling the true P&L.
Exactly. That means we have to separate the core operational reality of their poultry business, the actual chickens and eggs, from what looks like some very sophisticated financial engineering and, frankly, just massive treasury management.
That separation is absolutely critical here. I mean, this report presents one of the most fascinating contradictions I think we've seen all year. It's the story of two completely different periods.
It really is. If you just glanced at the year-to-date, the YTD numbers, you'd walk away thinking this company is in some serious trouble.
For sure. So let's start there. The YTD performance, it paints a very gloomy picture, doesn't it?
Oh, absolutely. It suggests they were struggling against some major headwinds for the first half of the year. We saw revenue fall by a pretty noticeable 8% down to Rs. $4.44 billion.
An 8% drop is significant, but the real alarm bells start ringing when you look at profitability.
That's where the pain was. Gross profit got hit even harder. It dropped sharply by 29% to just Rs. $931 million.
A nearly 30% drop in gross profit. I mean, if that's sustained, that signals a huge structural problem. It's either your input costs are exploding or your pricing power is just completely collapsed.
And that flows right down to the bottom line. Profit attributable to equity holders was down 26% year over year, hitting Rs. $932.3 million.
So by all measures, if you stop the clock after Q2, the investment thesis here would be purely defensive. You'd be thinking about survival, not growth.
But that entire narrative, that whole story, it just completely disintegrates when you isolate the single quarter figures for Q3.
It's not just a bounce. That's the key thing. This is a vertical inflection point. It completely changes how you have to assess the company's operational strength.
The change is genuinely staggering. Q3 revenue didn't just stabilize or tick up a bit. It jumped a massive 33% quarter over quarter to Rs. $1.73 billion.
33%. That tells you demand just came roaring back. But, revenue's only half the story. The profit surge is where you see the real fireworks.
That Q3 profit came in at Rs. $473.6 million. Now, to put that in context, to really understand how pivotal this one quarter was.
Yeah, bring that down for us.
That single quarter's profit accounts for 51% of the entire year-to-date profit.
Wow. So they made as much money in 3 months as they did in the previous 6 months combined.
Precisely. And year over year for the quarter, it represents a massive 132% surge.
Okay, so that's the million rupee question for us, isn't it? What on earth happened between Q2 when they were clearly struggling and Q3 when they posted these explosive numbers? This sets up the whole debate.
It does. Is this phenomenal profit surge a sustainable thing driven by real structural changes in their market? Or is this a one-off, something driven by weird inventory cycles or maybe some temporary pricing anomaly that's not going to last?
And we can't answer that without getting into the weeds. We have to dissect the business segments. So let's move into our first section, operational health. We need to go beyond that aggregate revenue number.
Right. We have to figure out which part of their business actually drove this massive Q3 bounce.
So let's unpack this. The source material is pretty clear here. TAFL is effectively running 2 parallel businesses right now, and their day-to-day realities are just diametrically opposed.
You've got the winners and you've got the laggards. Let's start with the clear winners, the parts of the business that just caught fire in Q3.
Okay.
We're talking primarily about the broiler day-old chicks, the DOCs, and the processed chicken segments. These are the engines of the business right now.
And the analysis confirms this is genuine operational strength. It's not a fluke. It was driven by 2 key factors: stronger demand, and this is the critical part, better pricing power.
Yes, that confirms organic operational health in their major consumer-facing segment. The demand recovery, well, that's likely a normalization of consumption patterns after some earlier economic pressure,
People are just buying more chicken again.
Exactly. But the pricing power part is much more telling. When a company can not only sell more volume, but also push through price increases, it suggests the market structure for broiler products has tightened significantly in their favor.
That means they're not just taking orders, they're setting the terms. They can pass through any input cost volatility like feed prices with ease.
And that's a sign of a very healthy, very dominant market position in that specific vertical.
So on the broiler side, The story is incredibly strong. Robust operational strength. But then you look at the laggards, and the investment story just flips completely. It reminds you of that YTD gloom we started with.
That would be the layer DOCs segment. So these are the layer chickens meant for egg production. The report is blunt about it. It says they are still bleeding.
And this isn't a TFL management problem, right? This is an industry-wide issue.
It's a structural problem, exactly. You need to understand the context here. The egg market itself is facing a substantial oversupply issue.
Okay, so what does that mean? Too many chickens laying too many eggs?
Pretty much. It's likely due to previous cycles where everyone overinvested in layer facilities when demand was high. Now you have too many laying birds in the market. That drives down the price of eggs.
Which in turn kills the demand and the price for the layer DOCs that TFL sells.
You got it. So their layer DOC segment is just constrained by these big macro market forces, no matter how well they manage their own costs.
So you have this high-flying, high-margin broiler business that's recovering dramatically and carrying all the profitability in Q3. And then you have this layer DOC problem that's acting like a constant structural drag on the numbers.
It is. And for an investor, you have to assess the weighting. The sheer magnitude of that 132% profit jump tells you something important.
Yes.
That the broiler recovery wasn't just healthy, it was overwhelming. It was powerful enough to effectively neutralize the ongoing problems in the layer segment and still drive massive year-over-year growth. The incremental growth is clearly 100% centered in broilers.
Okay, so this leads us directly to the margin analysis. Was this impressive Q3 improvement driven by, obsessive cost-cutting, trying to squeeze blood from a stone? Or was it a genuine resurgence in pricing power and efficient operating leverage?
The analogy I like to use is the company surviving by just tightening its belt, strict cost-cutting measures that can only last for so long? Or did they find a much better product market fit?
Because if you have a 33% revenue jump and a 132% profit jump, that spread is enormous. If revenue is only going up by a third but profit is more than doubling, something really dramatic is happening on the cost side or the margin side.
And the data strongly suggests it's operating leverage and pricing power. If the improvement were just from cost cutting, you'd typically see a more modest revenue increase, maybe 5 or 10%, combined with that huge profit spike.
Right, that would signify some kind of massive one-time expense cut. But we have a sharp increase in revenue and a disproportionate increase in profit. That tells me the broiler segment must have significantly higher margins than the company average.
That's the key. They benefited from this highly favorable environment where demand surged, allowing them to maximize pricing without a proportionate increase in their fixed or variable costs.
Can you break that down? What are the fixed costs in a chicken farm?
Think about it this way. Once the chicken sheds are built, the processing plants are running, and the staff are hired, those are your fixed costs. The marginal cost of producing one more broiler DOC is then relatively low.
So when prices rise in the market,
those incremental revenues flow almost straight to the bottom line. It leverages that fixed cost base, and that is exactly what we're seeing here in the Q3 numbers. It confirms the inflection point is rooted in real, organic operational strength.
Which is probably the most crucial takeaway for valuing the core business itself.
Absolutely.
So we've established the operational core is recovering strongly, even if it's a bit uneven. Now we have to shift gears and talk about what is arguably the single most defining and, peculiar characteristic of 3-acre farms.
And that's the balance sheet.
A balance sheet. If the operations are a tale of two businesses, the balance sheet is just a pure paradox.
Welcome to what we're calling the cash fortress paradox. This is where TAFL just completely deviates from anything you'd expect from an operational company, especially in a sector like agriculture, which is notoriously capital-intensive and cyclical.
The liquidity figures here are just. They're staggering. They really demand a deep dive.
Let's put the numbers on the table. Total liquid assets, and that's pure cash plus any short-term investments, stand at a whopping $7.53 billion. $7.5 billion. And that number only really hits you when you contextualize it against the rest of the company.
Exactly. That RS, $7.53 billion, represents 71% of the company's total assets.
71%. Let that sink in. This isn't a poultry farm with some extra working capital lying around. This is fundamentally a strategic investment fund that happens to maintain a very efficient, recovering poultry operation on the side.
And that distinction is critical. It's a fixed income fund that has chickens, not the other way around. And for an investor, you have to make that conceptual separation. But what's even more fascinating is the Treasury maneuver they pulled mid-year.
Right. They move toward what you're calling maximum liquidity mode.
We saw a huge capital shift between December 2024 and September 2025. This was active Treasury management. They weren't just sitting still.
Walk us through that shift. It reveals a lot about management's thinking on risk.
Okay, so at the end of 2024, their short-term investments, think high-grade commercial paper, fixed deposits, things that earn a small but steady return that stood at Rs 7.49 billion.
Almost their entire liquid pile. Right. By September 2025, that figure had plummeted to Rs 2.74 billion. They liquidated almost Rs 4.7 billion from income-generating assets.
Okay, so where did that nearly 5 billion rupees in cash go?
It went into their pure cash balances. Their cash on hand, the most liquid, instantly accessible capital. It soared from just Rs 64 million to Rs 4.79 billion.
That's an incredibly aggressive move. Out of low-yield assets into zero-yield, pure cash. An analyst looks at that and just sees the opportunity cost.
Yeah.
Why pull billions out of instruments earning even a few percent and move it into cash that earns absolutely nothing?
It signals one of two things, and both are related to extreme risk management or high strategic readiness. First, it could just be profound caution. By moving to pure cash, they completely eliminate any counterparty risk or credit risk associated with those investment vehicles. In a very uncertain economic environment, they might be prioritizing capital preservation above all else, and they're willing to accept that zero-yield penalty to do it.
That seems rational for a cyclical business, but the sheer scale of it is extreme. What's the other possibility?
The other possibility is extreme preparedness. The company might be anticipating a massive, immediate capital deployment opportunity that requires instant access to cash.
Like an acquisition.
A substantial one, an M&A deal that could diversify them away from the poultry cycle, or maybe a major unscheduled capital expenditure project that needs funding tomorrow, not in a week. Moving to maximum liquidity mode means the company is literally poised to write a massive check at a moment's notice.
So that's the strategic puzzle, isn't it? Is management being overly defensive, or are they hiding a potential acquisition target up their sleeve? We can't know for sure, but the balance sheet is screaming one of two things: ready for action or terrified of the market.
And nothing demonstrates that safety-first approach more clearly than their current ratio. This metric is just screaming low-risk tolerance.
Okay, so remind our listener, what is the current ratio and why is it important?
The current ratio is a simple health check. It's your current assets divided by your current liabilities. It just tells you if a company can cover its bills over the next 12 months.
And TFL's current ratio is?
A remarkable 7.3 times.
7.3. I mean, most healthy industrial companies are aiming for maybe 1.5x to 2.5x. Anything over 3x is usually considered extremely safe. 7.3 is just, it's unheard of in an operational business.
It means they have enough liquid assets on hand to pay off all of their short-term liabilities. Accounts payable, short-term debt, you name it, 7 times over. It is fortress-like. But it carries a massive opportunity cost.
It just screams underdeployment of capital. This is the absolute definition of safety, not efficiency. They are paying a huge premium for that stability.
And now we have to tie this colossal pile of liquidity back to the profit before tax, the PBT, because this is the fundamental distortion in the P&L that we have to correct for.
This is where the core operating business gets completely misrepresented by the headline numbers.
The interest income they derive from this Rs 7.5 billion cash pile isn't just some ancillary other income. It is a critical piece of their P&L. For the period, interest income accounted for Rs 453 million.
And when you stack that up against the total profit before tax,
it makes up roughly 34% of the entire PBT figure.
34%. We have to hammer that point home. A full third of their headline profitability, the number that hits the news reports, is derived from managing their treasury, not from growing and selling chickens.
Which brings us squarely to what we'll call advanced investor lesson number 1, which is mandatory if you're going to value TAFL properly.
And that lesson is?
Conceptual separation. You absolutely must separate the valuation of the core operating business from the cash pile. When you value TAFL, you are valuing two very different things. A poultry business showing a strong Q3 recovery, and a massive fixed income portfolio generating safe, consistent, but low returns.
But the step that often trips investors up is how you treat that cash.
Right.
You can't just add the cash pile dollar for dollar to the operating valuation because there are always consequences to deploying or distributing that much cash.
Precisely. You can't let the safety of that cash distort your assessment of the profitability of the poultry operations. The framework has to be value the core P&L, the 66% of PBT from operations, based on industry multiples and its growth prospects. Then you add the cash on top, but you need to apply a discount for potential tax consequences.
Okay, so if they were to say distribute that RS 7.5 billion to shareholders as a special dividend, what would that look like?
Well, depending on the jurisdiction and the structure, that distribution could trigger significant capital gains or dividend withholding taxes. So an astute investor has to factor in that a chunk of that cash pile, maybe 10 to 20%, might be lost to taxes upon distribution.
So unless it's used for a very tax-efficient, value-adding acquisition, that cash pile should be valued at less than its face value. Ignoring that discount means you're overvaluing the net deployable capital.
It requires mental discipline. Investors see the healthy overall profit figure and they forget that a huge piece of that YTD profit is just guaranteed treasury income. It's not scalable in the same way that expanding your broiler operations is.
And that leads us perfectly to our next section. We have to check the quality of those earnings. It's time for cash flow versus accounting profit.
The ultimate reality check. Cash is king. We need to verify if that high accounting profit is actually translating into real spendable money. Because in a sector like agriculture, it's very easy to create paper profits that aren't backed by physical cash.
This is the aggressive comparison every serious analyst has to make. We look at the net profit, that's the accounting figure from the income statement, which was RS 932 million YTD.
And we compare it directly to the operating cash flow, which is the reality of cash in the door from sales after you've paid your suppliers and your employees. And that number was RS 296 million.
The cash is higher than the net profit, significantly higher, by over RS 350 million. This is the gold standard for earnings quality.
It is. And the metric that synthesizes this is the cash conversion ratio, or CCR. They achieved a stellar 1.39 times CCR.
What does that 1.39x actually mean?
A CCR significantly above 1.0x indicates extremely high earnings quality. For every 1 rupee of accounting profit they reported, they actually generated 1.39 rupees of cold, hard cash from their operations.
So why would cash flow be so much higher than net income? What's the main driver there?
The biggest drivers are usually non-cash charges. Depreciation and amortization are the big ones. They run physical assets, sheds, machinery, processing plants. Those assets depreciate over time.
And that depreciation is an expense that reduces your accounting profit, but you're not actually spending any cash.
Exactly. The depreciation on their existing assets is a huge benefit to their operating cash flow. And beyond that, it also suggests that their working capital changes were highly favorable during the period. They must have managed their payables very well or liquidated inventory efficiently.
So this stellar 1.39x CCR is a powerful signal of financial health, even with that YTD revenue decline we started with. So we have recovering operations and incredible earnings quality. The cash they do generate is pure. So now we have to analyze where that cash is actually going. Let's look at free cash flow and their deployment strategy.
Right. Free cash flow, or FCF, tells us what cash is left over after you've maintained and expanded the business. We start with that robust OCF of ours, 1,296 million. And from that, we have to subtract the necessary investments.
And this gets interesting because their CapEx is split into two very distinct categories.
It is. First, they spent Rs 258 million on traditional capital expenditures, property, plant, and equipment, or PPE. That's your typical maintenance CapEx for a farm and processing business. But the second category is the one that needs a bit more explanation.
And that would be the bioassets.
That's the Rs. 508 million they invested into bioassets. For a poultry farm, bioassets are the flocks themselves, the breeding stock, the day-old chicks held for growth, the layers. This isn't like buying a new tractor. This is buying the raw material that produces your future revenue stream.
That's a really important distinction. Investing in bioassets is almost closer to investing in highly productive working capital than it is to traditional long-term CapEx.
That's a great way to put it. Traditional CapEx is a longer-term bet. Investing Rs 508 million in bioassets is a shorter, often very high return investment in the core productivity cycle. It suggests management is actively reinvesting in the farm's fundamental capacity, likely to capitalize on that returning demand we saw in Q3.
So the total reinvestment was Rs 766 million. That's the PPE plus the bioassets.
Right. So you take the Rs 1,296 million in OCF, you subtract that Rs 766 million in total reinvestment, and that leaves them with a free cash flow of Rs 530 million.
$500 million rupees. That's the cash that was generated and available for distribution to shareholders or for further treasury management after they fully funded all their growth and maintenance needs.
And generating $500 million in FCF after pouring over $750 million back into your physical and biological assets. That is a very, very strong performance. It shows the core poultry business is a potent cash generator when that broiler segment is humming.
And what about deployment? Did they just hoard that FCF and add it to the big pile?
No. The company returned Rs. $706 million to shareholders via dividends.
Which is actually more than the free cash flow they generated.
It is. The dividend payout was more than the FCF, so they slightly drew down on their existing cash or retained earnings to fund that dividend. It shows a real commitment to rewarding shareholders even while they're aggressively reinvesting in the business. It's a balanced, shareholder-friendly approach.
But we have to keep reiterating, the overwhelming majority of their capital, that Rs. $7.5 billion treasury allocation, remains the major strategic outlier in all of this. Okay, so far the summary is excellent. We've got recovering operations, zero debt risk, and exceptionally high-quality earnings. But as analysts, we can't get too comfortable. We have to flip the report over and look for the cracks. And there is a significant early warning system flapping in this report.
Ah, yes. The receivables surge.
The receivables surge. This is the critical metric that points to potential trouble ahead, and it demands close monitoring in Q4.
We need to focus on trade receivables. These are essentially sales made on credit that haven't been collected yet. This is where that high cash conversion quality we were just praising can quickly evaporate.
Let's look at the data, because the numbers here are genuinely alarming for a company with such a strong cash position. Trade receivables doubled. They went from Rs. $130 million at the end of December 2024 to Rs. $265 million by September 2025.
That's a 104% jump in outstanding customer debt.
And here's the part that elevates this from just a warning to a potential threat. That 104% jump happened against a backdrop where YTD revenue was down 8%.
Even if we're generous and we only look at the Q3 recovery, that 33% revenue jump, the rate at which their receivables grew is still vastly outpacing the rate of their sales growth.
It's completely unsustainable mathematically. If you are selling 33% faster in one quarter, but your uncollected bills are growing at over 100% since the start of the year, that massive gap signifies something fundamental is wrong with the quality of those sales or with the collection process itself.
There are two likely interpretations of this risk, and neither of them are particularly good. Interpretation 1. They may have loosened their credit terms specifically and aggressively to drive that impressive Q3 sales growth.
So they told customers, hey, you don't have to pay for 60 or 90 days instead of the usual 30. The customers then buy more volume, and TAFL gets their 33% revenue surge on paper. But they're effectively loaning them the money for that extra period, and that traps their cash.
That's exactly it. Interpretation 2. It could just signal slower collection times from their core customers. This would mean their clients, the distributors, the wholesalers are struggling financially and are delaying their payments. That's a potential red flag for the health of the entire downstream poultry market.
Either way, it means TAFL is trapping its otherwise pristine cash flow, that wonderful 1.39x CCR, in credit sales. If this trend continues into Q4, that high cash conversion quality will rapidly erode.
And they'll become increasingly reliant on liquidating that Rs. $7.5 billion cash pile just to maintain their working capital, even while they're generating high profits on paper.
And this is our advanced investor lesson number 2.
Watch the receivables to revenue ratio religiously. Revenue can recover beautifully on paper like we saw in Q3. But if the cash stays trapped in credit sales, that paper profit is meaningless for paying dividends or funding future capex.
A doubling of receivables against flat or declining YTD revenue is a textbook early warning system. For TFL, given their cash fortress, maybe the urgency is lower than it would be for a debt-laden company, but it still represents a leak in the high-quality earnings boat we just identified.
We absolutely need to see the Q4 data to confirm if this was just a weird anomaly tied to that Q3 sales surge that has since been corrected, or if this is a new worrying trend in their sales policy.
Right. Okay, so now let's bring the entire analysis full circle. Let's look at the efficiency checks, return on equity, and return on assets to see how effectively management is actually utilizing this enormous pool of capital they possess.
Their annualized return on equity, the ROE, stands at 12%, and the return on assets, ROA, is 14%.
Which are solid figures in isolation. They're not bad, but they're certainly not exceptional for a company that's showing a 132% quarterly profit surge in its core operations.
And the reason those returns aren't higher comes back inevitably to the cash fortress paradox. That Rs 7.5 billion pile is actively dampening their efficiency metrics.
Explain how that works mechanically.
Remember that Rs 7.53 billion sitting in liquid assets. That cash is included in the assets denominator for ROA, and it's also a huge part of the equity denominator for ROE.
And since that cash is only generated at safe, low-interest income, the 34% of PBT we talked about, it significantly drags down the overall return metrics.
It drags them down compared to the high-margin, capital-efficient broiler operations. It creates a statistical illusion. That 12% ROE is a measurement of the return on the entire enterprise, including the treasury fund. But the return on the core poultry business itself, that other 66% of PBT, must be substantially higher to get to that overall 12% average.
So if we were to strip out the cash pile and calculate a hypothetical core ROE just on the poultry business, what do you think it would be?
I mean, if you stripped out that Rs 7.53 billion and just looked at the assets needed to run the poultry business, that core profitability would likely be in the high teens, maybe even low 20s. That 12% figure is incredibly misleading as a measure of operational efficacy. It masks the true brilliance of the broiler segment.
And this leads us to the ultimate strategic dilemma for this company. Our advanced investor lesson number 3. We have this unique combination of metrics. High cash conversion at 1.39x, combined with a relatively low headline ROE of 12%, and that fortress balance sheet with a 7.3x current ratio.
And what does that combination scream to a financial strategist?
It screams underdeployment.
Underdeployment. TAFL is generating money, converting it to cash brilliantly, and then effectively refusing to spend it or deploy it efficiently. They are prioritizing capital preservation far, far above capital growth and value creation.
Let me push back on that for a second, though. Given the extreme volatility in commodity markets, especially feed costs, and the cyclical nature of poultry prices, isn't prioritizing safety a perfectly rational strategic choice for a company in this sector? They're just insulating themselves from the next inevitable commodity price shock.
It is rational for risk avoidance, but it is not rational for shareholder return optimization. There's a difference. They've mitigated all the risk, yes, but in doing so, they've also capped their own growth. They are holding capital at an extremely low return rate when they could be generating much higher returns in their core business.
Or, alternatively, returning that low-yielding capital to shareholders who can then go and redeploy it somewhere else for a better return.
Exactly. The company has a significant fiduciary obligation regarding that Rs 7.5 billion. They have two major strategic paths they can take.
Path 1.
They either need to reinvest that Rs 7.5 billion aggressively into expansion, build new high-efficiency broiler facilities, expand their lucrative processed chicken capacity, or make synergistic acquisitions that could push them out of the cyclical commodity market.
And path 2.
Or, if they genuinely cannot find value-accretive uses for that cash that can beat their core operational ROE, and their recent move to pure cash suggests they might not see any immediate opportunities, then they must return substantially more capital to shareholders than the Rs 706 million dividend they just paid.
They have the capacity for a massive special dividend or a huge share buyback program.
The current analyst viewpoint is pretty clear on this. Investors are paying a premium for the safety and stability that Cash Fortress provides, but they are not paying for efficient use of capital or for robust growth prospects from the core business alone. The current structure is acting as a self-imposed growth inhibitor.
The irony is that high interest income is making the P&L look healthier, but it's simultaneously distorting the ROE, creating this strategic allocation problem and capping the multiple the core business can command.
It's a classic example of safety coming at the explicit cost of aggressive return potential.
So let's wrap up this deep dive. Let's summarize the findings for the true P&L of 3 Acre Farms for Q3 2025.
I think the core findings are threefold. First, operationally, the company is recovering very strongly. That's evidenced by the massive Q3 inflection point, driven almost entirely by the high-margin broiler segment.
Second, the earnings quality is exceptionally high. That cash conversion ratio of 1.39x is stellar. It means their accounting profit is real, and it translates into spendable cash very quickly.
And third, they possess zero debt risk. They're backed by that fortress balance sheet with a 7.3x current ratio, a clear sign of hyper-conservative risk management.
And the necessary cautionary note, the red flag, is that massive 104% receivable surge. That demands close attention in Q4 to make sure their sales quality isn't deteriorating just to keep the growth numbers up.
And the overall strategic overhang remains the most critical point for valuation. The big question is, what will TAFL do with the Rs? 7.5 billion in liquidity. Until they commit to either aggressive, value-accretive deployment or a significant capital return program, the stock will likely continue to trade at a discount relative to its core operating potential.
We established that 34% of their profit before tax comes purely from treasury income from that massive cash pile. So for our final provocative thought for you, the listener, we want you to conceptually separate these two businesses, the cash fund and the poultry operator.
Ask yourself this: what would your fundamental valuation of the core TFL poultry business be if that our 7.5 billion cash pile were fully distributed to shareholders today?
It forces you to look at the poultry operations on their own merits, their recovering margins, their operational risks, and their true growth potential, without the comforting security blanket of the fixed income fund they're currently operating. That true core valuation is what really matters for evaluating management's ability to drive future growth.
And as always, remember our initial disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research.
Thank you for joining the deep dive.